Hi everyone and welcome to Quick Take Review. Today we are continuing on from yesterday's Quick Take episode on Palantir. Now before we go on, to those who are new to this channel, The Naive Investor is a YouTube channel that focuses on anything that relates to investing and trading. Currently we have two series. The first is Quick Take, where we try to analyze the financials of a company in less than 10 minutes. The other is the Early Bird, where we look at the news, analyze how it will affect the markets. If this sounds interesting to you, please hit the subscribe button to stay up to date. So, a quick recap on yesterday's episode of Quick Take. Palantir is a software company that provides data analytics tools for government and commercial institutions. As the company's financial data was quite scarce, we could not do a proper fundamental analysis. Looking at the chart, the company was resting on its 78.6% Fibonacci retracement level. However, the previous session saw the price drop by 12.75% towards a 61.8% level. This is due to the lockup period expiring and the markets being flooded with shares, increasing the supply. Now the question we are trying to answer is, has the lockup expiry been priced in? Or in other words, can it go any lower? First of all, what is a lockup period? Basically, it's a period of time during which shareholders are prevented from selling a certain portion of their holdings. This period of time can range from 90 to 180 days. For special purpose acquisition companies IPO, this period could be longer, anywhere from 180 days to 12 months. Lockup period is usually applied to companies' insiders such as founders, owners, managers, and employees. Sometimes it could also be applied to venture capitalists and other early private investors. Once the lockup period has expired, those insiders and early investors are free to sell their shares. Such an event increases the supply of the company's shares in the market and drives down the share price. This is because insiders are usually given shares as part of their employment contracts. Meanwhile, early investors and venture capitalists usually buy shares at IPO in huge quantities. If the share price goes up after an IPO, then the shareholders can afford to sell their holdings at a much lower price than that of the market. This profit-taking sell-off causes the share price to fall. So let's get back to our original question. Has the lockup expiry been priced in? From my perspective, it has. This is because it's a known and normal event for recently listed stocks. Another factor to consider is that Palantir did not have an IPO. It had a DPO, or direct public offering. The main difference between an IPO and a DPO is that the institutional investors did not get a chance to get in before the general public. That is why Palantir has such a low portion of institutional shareholders. The shares that were sold during the DPO belonged to the early shareholders who were allowed to sell up to 20% of their holdings. The other 80% were locked up until now. This is a good thing because institutional players would have created a bigger sell-off since profit-taking is part of the game. Then what caused the share price of Palantir to fall? From my experience, the market tends to overreact, and this is likely to be the case here. I am sure there would have been some profit taking from those early shareholders, and that will affect the price to a certain extent. However, to think that everyone sold off their shares for a quick buck is somewhat overly cynical. There are undoubtedly early shareholders who believe in the company and held on, or even bought more during the dip. I think Palantir has a pretty good product lineup. Palantir's government-oriented Gotham platform provides stable business for the company. Meanwhile, Foundry has already secured big contracts from UK's National Health Service. Also, data-driven decision-making is a big thing in management right now and for the foreseeable future. That's why I believe platforms like Foundry will undoubtedly gain momentum. To summarize, the drop in share price is expected and the effect of the lockup period expiry is already priced in. The factors that can influence the magnitude of the drop can be fear or greed from the current shareholders and overreaction from the market. According to a research paper from Stern School of Business, share prices can drop by 1 to 3% after a lockup expiry. Another research has shown for tech shares, lockup expiry can cause a median drop of 11%. For example, when Facebook went public, its share price was $38 per share. After its lockup period expired, the share price dropped by almost 50%. Within a couple of months though, it regained 50% and is now trading at approximately $270 per share. For me, it is a great time to buy a dip, as I am planning to hold on to this company for a few years to come because I believe it has great potential in the future. If you are a short-term trader, then prepare for some volatility. And that is pretty much it for today's quick take review episode. episode. If you like what you see, please share, like, and subscribe to support what we do here at The Naive Investor. Feel free to share your thought about this company in the comment section below and check out our other videos. Until next time, stay safe and keep looking for opportunities.